Hey guys, it's Raj. In this video, we're going over what I would consider the top 5 monthly paying covered call ETFs. So all of these options have high dividend yield, pay monthly, and are trading very close to, if not above, when they were first introduced to the markets, which means they are not dividend traps. Remember, I'm not a financial advisor and this isn't financial advice, but if you're looking for covered call ETFs, they're, in my opinion, actually worth investing in because they have the ability to grow over time and pay you while you wait. This video is for you. Our number 5 ETF is XYLG, also known as the Global X S&P 500 Covered Call and Growth ETF. XYLG seeks to generate income by writing covered calls on the underlying index, in this case, the S&P 500. Quick note, an ETF is an exchange-traded fund. This means the money is pooled together and the fund invested for us. So in the case of XYLG, the fund will buy stocks of companies in the S&P 500 and write options using those shares as collateral. The money that those options generate comes back to us as investors in the form of dividends. So instead of having to own 100 shares of an individual company, which can be expensive, and figure out how options work, which can be risky for an individual investor, and then monitor those trades, which is time consuming, well, this covered call ETF does all that for us. So with covered call ETFs, you don't have to risk your shares in case an option trade doesn't go your way, but you do get exposure to the underlying asset, and you still get the higher dividend just for owning the ETF. XYLG has 504 holdings, and its top holdings include Apple, Microsoft, Amazon, Nvidia, Google Class A shares, which have voting rights, Tesla, Meta, Google Class C shares, which do not have voting rights, Berkshire Hathaway, and United Health Group. The ETF has a 10.38% annual return since inception. So if you invested $10,000 back in September of 2020, your investment would now be worth $13,196.13. Compare this to VOO, which tracks the S&P 500 over the same time frame, you end up with $14,165.04. XYLG has a current dividend yield of 4.15%, which is way higher than what you would get from something like VOO at 1.51% or QQQ at 0.53%. But I agree, 4.15% is not that impressive. I've seen much higher dividend yields, and it's not even the highest yield on this list. In fact, all the other ETFs on this list have higher yields, so stick around for those. But we have to be careful with the high dividend yield investments because we want to avoid dividend traps. That's when an asset is paying a really high dividend, but the overall value is going down. QYLD was an extremely popular covered call ETF in the past, and it did well on shorter time frames, don't get me wrong. But over the long term, I can't justify the high yield given its overall performance. A really quick way to see if an ETF or stock is a potential dividend trap is to just look at the price chart over the long term. In the case of XYLG, it was first introduced to the market in September 2020 and was trading around $25. As of making this video, it's trading at around $28. In terms of how risky this ETF is on a scale of 1 to 5, with 1 being the least risky and 5 being the most risky, I'm giving it a 3 out of 5 because it's S&P 500 based and it's been around since 2020. So there's a larger time frame available for us to see how the fund performed. It has an expense ratio of 0.60%, which means it costs you $60 a year per $10,000 invested to own it. Generally speaking, anything below 0.79 is what I would consider a good expense ratio for covered call ETFs based on the average from ETF.com, and anything above it should have a larger return to justify the extra cost. Investors can expect a monthly dividend of 8 cents to 13 cents per share based on 3 years of dividend payouts. Now, XYLG is a great covered call ETF, but our next ETF has an even higher dividend yield. Our number 4 ETF is DIVO, also known as the Amplify CWP Enhanced Dividend Income ETF. DIVO is an actively managed ETF of high-quality, large-cap companies with a history of dividend growth, along with a tactical covered call strategy on individual stocks. DIVO is strategically designed to offer high levels of total returns on a risk-adjusted basis. DIVO has 35 holdings, and its top holdings include Microsoft, Visa, United Health Group, Procter & Gamble, Chevron, McDonald's, Goldman Sachs, Apple, and Merck. The ETF has an 11.79% yearly average return since inception in December of 2016. So if you invested $10,000, your investment would now be worth $20,865.09. Compare this to VOO over the same time frame, you would have $22,462.90. DIVO has a current dividend yield of 4.6%. When it was first introduced to the market, it was trading at around $25, and today it's trading close to $36. And by the way, if you're not familiar with dividends from covered call ETFs, they work a little differently than your average dividend, so that affects your taxes. So stick around to the end of the video where I go over that in more detail. In terms of how risky this ETF is, I'm giving it a 2 out of 5 because of the length of history we have for the ETF and its impressive returns since inception, and its underlying holdings are very recognizable, stable companies. It has an expense ratio of 0.55%, which means it costs you $55 a year per $10,000 invested to own it. Investors can expect a monthly dividend of 10 to 15 cents per share share based on the past 3 years of dividend payouts. Moving on up the list with an even higher dividend is our number 3 ETF, QYLG, also known as the Global X NASDAQ 100 Covered Call and Growth ETF. QYLG seeks to generate income by writing covered calls on the underlying index, in this case, the NASDAQ 100. QYLG has 102 holdings, and its top holdings include Apple, Microsoft, Amazon, Nvidia, Meta, Tesla, Broadcom, Google Class A shares, Google Class C shares, and Pepsi. The ETF has a 9.73% yearly average return since inception in September of 2020. So if you invested $10,000, your investment would now be worth $12,999.41. Compare this to VOO over the same time frame, you would have $14,264.33. QYLG has a current dividend yield of 5.99%, and when it was first introduced to the market, it was trading at around $26, and today it's trading close to $28. In terms of how risky this ETF is, I'm giving it a 4 out of 5. It does have a few years of history and decent returns, but it does invest in tech stocks and writes covered calls to generate income, which adds volatility. It has an expense ratio of 0.60%, which means it costs you $60 a year per $10,000 invested to own it. Investors can expect a monthly dividend of 11 to 14 cents per share based on the past 3 years of dividend payouts. Moving our way up the list to one of my favorite investments, our number 2 ETF is the very popular JEPI, also known as the JP Morgan Equity Premium Income ETF. Its goal is to deliver monthly distributable income and equity market exposure with less volatility. JEPI is a covered call ETF and works through equity-linked notes. It uses its holdings to write options contracts, which lets the fund collect a premium through an agreement with a financial institution. This premium is how the fund generates such a high yield. In basic terms, an equity-linked note is an investment where money is lent to a financial institution and then invested in stocks, options, or indexes. The party receiving the money can guarantee 100% of the money lent will be returned, which eliminates the downside risk for the fund. Of course, that comes at a cost though, so whatever profits are made are usually capped. JEPI has 136 holdings, and its top holdings include Adobe, Microsoft, Amazon, MasterCard, Comcast, Pepsi, Accenture, Intuit, Visa, and Costco. The ETF has an average yearly return of 13.26% since inception in May of 2020. JEPI's only been around since May of 2020, but if you invested $10,000 at inception, your investment would now be worth $14,823.75. Compare this to VOO over the same time frame, you would have $16,043.37. JEPI has a current dividend yield of 7.72%, and when it was first introduced to the market, it was trading at around $50. Today, it's trading close to $55. In terms of how risky this ETF is, I'm giving it a 3 out of 5. It has a few years of history and a decent return, and its holdings are S&P 500 based. It has an expense ratio of 0.35%, which means it costs you $35 a year per $10,000 invested to own it. Investors can expect a monthly dividend of 25 to 62 cents per share based on the past 3 years of dividend payouts. And our number 1 ETF with the highest dividend yield on the list is JEPQ, also known as the JP Morgan NASDAQ Equity Premium Income ETF. The ETF seeks to generate income through selling options and investing in stocks based on the NASDAQ 100 index, and like JEPI, also uses ELNs. JEPQ has 87 holdings, and its top holdings include Apple, Microsoft, Google, Amazon, Nvidia, and Meta. Its other holdings look a little strange. That's because these are the equity-linked notes. JEPI also has these listed just further down on its holdings list. The ETF has an average yearly return of 10.03% since inception in May of 2022. If you invested $10,000 when the ETF was first available, your investment would now be worth $11,223.93. Compare this to VOO over the same time frame, you would have $11,205.75. JEPQ has a current dividend yield of 8.99%. When it was first introduced to the market, it was trading at around $49, and as of recording this video, it's trading just under that $49 mark. Given it's basically on par with returns from the S&P 500 since inception, I consider this an accomplishment given the high dividend moving forward. In terms of how risky this ETF is, I'm giving it a 4 out of 5. It has a limited history and decent returns, but it's based on volatile tech stocks. It has an expense ratio of 0.35%, which means it costs you $35 a year per $10,000 invested to own it. Investors can expect a monthly dividend of 33 to 68 cents per share based on the past dividend payouts. Through my research, there were a lot of covered call ETFs that didn't fit my criteria. Some of them were incredibly risky despite the high yield and didn't offer the growth and stability I was looking for. But I wanted to include this one as a bonus because I think it has a lot to offer for a conservative investor that wants to capitalize on the covered call strategy. The ETF is KNG, also known as the FT Vest S&P 500 Dividend Aristocrats Target Income ETF. This ETF doesn't pay monthly, but I do believe it should be on every covered call ETF investor's radar. KNG seeks investment results that correspond to the price and yield of an equity index called the S&P 500 Dividend Aristocrats Target Income Index Monthly Series. KNG has 133 holdings, and its top holdings include Pentair, Albemarle, S&P Global Inc., Stanley Black & Decker, Caterpillar, Cardinal Health, Essex Property Trust, Brown & Brown Inc., W.W. Granger, and Ecolab. The ETF has a 10.24% annual return since inception. So if you invested $10,000 back in March of 2018, your investment would now be worth $16,814.75. Compare this to the S&P 500 over the same time frame, which would be worth $18,625.71. KNG has a current dividend yield of 3.74%, and it was first introduced to the market in March of 2018, where it was trading around $40. As of making this video, it's trading around $54. In terms of how risky this ETF is, I'm giving it a 2 out of 5 because it's heavy on dividend aristocrats and it's been around since 2018. So there's a larger time frame available for us to see how the fund performed. It has an expense ratio of 0.75%, which means it costs you $75 a year per $10,000 invested to own it. Investors can expect a quarterly dividend of 16 to 50 cents per share based on past dividend payouts. Now that we have a solid list based on the data, let's make sure we understand these kind of investments a little better before we put our money into the positions. How do covered call ETFs even work? Basically, the fund managers will buy stocks and write options contracts with the stocks as collateral. In return, they collect a cash premium. You can do this yourself if you own 100 shares of an individual stock outright on your phone using apps like Robinhood or Webull. If the stock stays within a certain price range for a certain amount of time, the fund keeps the premium. The premium is how they're able to pay such a high yield, but remember, this comes with an increased risk of losing money because markets are volatile and price changes happen all the time. There's a chance the price moves out of the range and the fund has to sell shares to cover the terms of the options contract, which likely means they lost money, which is not good for our holdings. These kinds of ETFs haven't been around for a long time, so we don't have a lot of history to work with. So if you decide to invest, be sure to monitor the performance and adjust your positions accordingly as you or your financial advisor sees fit. You're also going to want to know that the covered call ETFs are not the best for growth. Because of the option strategy, they are naturally limited in their upside. All right, so what kind of investor is a covered call ETF best for? In my opinion, these ETFs are probably most appealing to someone looking for income from their investments, not necessarily growth. And the investor should have a larger risk tolerance given that these are risky assets. All right, so when do covered call ETFs work best? They seem to work best in flat or bull markets, and how much you get in dividends regularly is going to depend on the premium generated, which can vary over time and is also affected by market volatility. But remember, when markets are going up, covered call ETFs are naturally going to underperform the market. But what about taxes? A majority, if not all of the dividends you get from covered call ETFs will most likely not be qualified, so you won't receive any favorable tax treatment from these payouts, depending on what kind of account you have them in. Some of the dividends paid out might be qualified since some of the dividends might come from the stock holdings, but I would not expect a covered call ETF to be tax efficient in any way because a majority of the yield probably comes from options. Now here's a great question. How is the expense ratio paid? Investors don't typically see a fund taking their fee out directly. It happens on the back end. And honestly, after my research, I wasn't really able to find a good explanation of how it actually happens. My best guess is that it's just accounting magic, but just because you don't see it doesn't mean it isn't happening. The fund has to make money. So investors might want to consider finding a fund that has a low or average expense ratio, and if it is higher than the average, make sure that the expected returns are worth the extra fees. All right, but what about the other covered call ETFs? You've probably heard about XYLD, RYLD, QYLD, SVOL, and other covered call ETFs. This list was created with the intention of avoiding ETFs that were losing value over time, and specifically avoided excessive risk in the case of SVOL, at least in my opinion. But if you think a covered call ETF should be on my radar, let me know what it is and why in the comment section down below. Now there's two quick things I want to go over that every dividend investor should know. First is how much you'll receive in dividends per share based on the dividend yield. To do this, take your dividend yield, divide it by 100, and multiply this by the price of the stock or ETF. That gets you your yearly dividend if you own one share. But now let's expand on this. The second thing we're going to learn is how much you need to have invested to make $1,000 a year in dividends. Our second formula is $1,000 divided by the dividend yield expressed as a number, which means you divide that number by 100. This gives you the amount you need invested to make $1,000 a year in dividends. Now let's take it one step further with an example calculation. So from the thumbnail, in order to get $894.73 a month in dividends, we take that and multiply by 12. This gives us $10,736.76 in annual dividends. So now we're going to divide that number by the dividend yield. So let's say we wanted to use JEPI's dividend yield of 7.72%. We're going to divide by 0.072 and we get $139,077.20 needed invested in a JEPI. The numbers you calculate with this formula might seem like a lot at first, but remember, it's a marathon, not a sprint. And thanks to compound interest, I believe it's possible for everyone to get where they want to be financially. So good luck in the markets. I appreciate you watching the video. And if you found value in it, hit that like button, subscribe for more, and I'll see you in the next video. Take care.